Hi, I'm Keith McCullough, and welcome to another Real Conversation with no stranger to Hedgeye TV or Real Conversations, one of my favorites when it is getting into the weeds and the plumbing of all this stuff. Everything from Federal Reserve to obviously credit, banks, all that fun stuff. Chris, thanks for making the time.
My pleasure, Keith.
Yeah,
And here we are face to face again.
So I don't know what to go with first, liquidity traps or credit crisis or full-blown credit cycle. There's so many clients that you and I talk to on the institutional side that are trying to get the timing right. And I know what my answer is, but maybe let's just start with yours, because you just wrote a very good note on what you call Powell's liquidity trap. Yeah. So we'll do the liquidity piece first, and then we'll get into credit.
Sure. Well, I think to set the stage for our viewers, if you think about the past, the most famous inflation fighter, okay, which is Paul Volcker.
Yep.
The big difference in those days was that the only thing the Fed did was change the indicated target for Fed funds. They were in the process of nationalizing the Fed funds market, right? And turning it into a terrarium inside the Fed's laboratory in Washington. Yep. But in those days, it was a private market. Today, however, you have people like Fred Mishkin saying, look, don't make the mistake that Volcker did in 1979. Don't let up, fight the inflation. And he's right. Fred is absolutely right. The difference, though, is that in the intervening years, the Fed has become more interventionist, and they have taken a much heavier approach to pursuing the conflicted dual mandate of full employment, price stability. You can't do both. Americans love inflation. We need to give the Fed one mandate, which is price stability, so we can lean against the natural tendency of Congress to issue too much debt, and Americans generally do at least want 3 to 5% price increases every year, right? So because the Fed went in and mucked around, particularly buying large numbers of securities, they drove rates down. We refinanced every other mortgage in the United States between 2020 and 21. And so you're left with a term structure of interest rates. In other words, the distribution of coupons that were issued recently that's very concentrated. So think about mortgage-backed securities, between 2 and 4.5% coupons for Fannie, Freddie, Ginnie securities. That's 75% of the market now. So when you move the Fed funds target 5-6%, the stress on the system caused by this is dramatic. Look at the fact that Marty Gruenberg, the longtime chairman of the FDIC, I don't think he'll ever leave, by the way, and he's good at it. He adds a new chart to their disclosure last week showing the unrealized losses by U.S. banks. Good. Got almost up to $700 billion in the third quarter. It got better in the fourth quarter because we had a rally.
Yep.
Rates went down, MSRs went down, bonds went up, right? Well, problem is U.S. banks are still sitting on a huge amount of securities that have very low coupons, that trade in the 70s and the low 80s. And as a result, these unrealized losses make these securities impossible, quote unquote, to sell. But what happens if they go underwater, like the S&L crisis in the 80s? This is the structural problem that Powell has created. And I think it goes back to Chairman Bernanke.
The structural problem that he sits on top of after Yellen, Bernanke, like you're saying, because you went back 20 years, right? So I'm just kind of thinking through, like this, you can't just do what you did in the 1970s and assume it's like the same exercise.
No, and I think also the Fed has to understand that open market operations are not open-ended. Yep. When they become the market, when they subsume private market activity and put government first, they are, I think, violating the law. Congress never gave them that power. The Fed doesn't have power over market structure. That belongs to the SEC. And I got to tell you, I think there are many times when the Fed takes necessary and proper, which is the constitutional rubric under which they operate, and they go too far. The Fed chairman, I don't care who it is, has to have the courage to go to Congress and say, I'm out of bullets. I can't do any more. This is up to you now. And instead, the Fed, in their arrogance, has decided to substitute their own judgment for the will of Congress. They're afraid to go and ask them. But they don't have that right. That is not the choice that the Fed chairman should ever make. And when Powell says that he can't lecture Congress about fiscal matters, no, I'm sorry. That's your job, Mr. Chairman. And if you don't like it, you should resign.
No, I mean, Janet Yellen can lecture Congress about climate change. I mean, it's like ridiculous. But I mean, so liquidity, just to simplify it for people, and you just can't get out of these things. And a lot of these things aren't really marked to market. We can talk about the entire edifice of everything from student loans to private equity, all these
All
marks.
fixed income securities are affected by this.
Right.
It's most dramatic with mortgage securities because their duration changes.
Yep.
Given interest rates. This is the thing that blew up long-term capital management and Kidder Peabody. The Fed has now made their own mistake.
Well, this is, I mean, it's like, I mean, I've had arguments with the Fed. I've employed the former vice chair of the Fed, here. We don't work together anymore, but the Fed called me last week. This is like, I've resolved, at least in my own thick skull, that they don't do rate of change. They do levels.
Yes.
They don't. They do, and moreover, because they don't do rate of change, they don't respect that a small move in the level, but a large move in the rate of change can create like nonlinear, moves based on the prior, which is the colossal mess of illiquidity that you've created.
Right.
So I just like, that's why, actually, when they called me last week, I wasn't in a rush to get back to. They're calling me on ODT options, but I mean, it was like, I don't think that unless you had somebody else, you'd have to really have somebody else come in and say, look, rate of change matters. This is your mess. You created it. The whole buy side talks about it all the time. I can't get out of anything.
Well, I think we should put the Secretary of the Treasury back on the Federal Reserve Board, okay? Because we have
When was the last time that happened? You're
a
such
long time ago.
Yeah.
Half a century. But the point,
half a century.
No, but the point is that
Just
there's
don't make it
nobody
hurt.
sitting at that table that understands markets. These are academic economists or, former operations managers who become economists. Like, it's a menagerie of non-real world folks.
Yeah.
And I think that over time, as the financial crisis, both for the federal government and the private sector, which is being dragged along by the Treasury as they go, what are we, $35 trillion worth of debt now?
Yeah.
The volatility that's going to cause is going to play havoc with the private sector. And eventually we're going to see legislation to reform the Fed.
Well, I mean, on that, I want to go two places that you've already gone. I want to go to the household credit risk, and I want to go to the corporate credit. We'll do corporate first, but it's like you have this. You're constantly today. Again, you got a new high for at least the short end of some of cost of capital. 2-year notes are right around 4.9, right? And you're like sitting there saying, I think I've seen the credit risk, but I haven't seen all the credit risk. Blackstone today comes out, or last night, and they're funny, right? Because they're like, we don't have a problem, but every time they update, we have a problem. Like BREIT, I don't know if you saw, but like people wanted like almost $4 billion back, and they could only give like 1.5. It's like
takes a long time to sell commercial property.
Like what the hell? But anyway, so on.
But remember, those markets flowed off a SOFR. They flowed off of spreads of this artificial thing that we substituted for LIBOR.
Just put it in there.
It kind of sort of trades like a zombie. But the point is that short-term finance of all sorts gets priced off the bottom of the curve.
Yeah, exactly. So that I look at that every day, and I keep saying to myself, I mean, it's not a question of if, it's just when. And the whole buy side's sitting there waiting to see how bad it's going to be. So what is that when we say corporate, I mean fully loaded with all the invested products, all the institutionalization of all this shit, all this illiquidity. When are you looking for credit risk like in big bang terms in the next 3 to 6 months? Is it going to happen slowly then all at once? It's just going to be with us for half a decade? How do you think about it?
I think there's going to be idiosyncratic risk in terms of the banks that weren't paying attention last year. The ones that didn't realize that quantitative easing was temporary and that we would go back the other way. We lulled the entire street to sleep. So people stopped hedging interest rates and they just stayed long equities. And they were going the same way, remember? We had full correlation. So now that we're restoring correlations, and I look forward to the big flip, which is when the US goes back to a premium in swaps and is no longer at a discount, okay? That'll show you that we're headed for the US credit crisis.
So you think that's coming? You mean credit? So your credit risk is full blown with the sovereign included?
It's just a matter of cost. If I can't hold on to that Ginnie Mae 2 because my cost of funds is now 3%, okay? If I can't pay my debt without taxing my people into oblivion or embracing hyperinflation. Okay, that's where the U.S. is headed. And this is a Latin story. I used to work in the emerging markets, Mexico. We've seen this movie before, but Americans in their hubris think it can't happen to them.
Oh man, and the amount of times I've been told that it can't happen. Interestingly,
but it's demographics. You have to wait for the end of the boom. It's at the end of the boom we really start to feel this.
It's you triggered something in my head. That's why I love real conversations, because you never know where they're going to go.
You never know.
But big firm in Boston, they have macro strategists. We have to fill out every month, a series of questions, asset allocation, weights. And for the first time, the question was, what is the probability of a U.S. credit default? And I was like, I haven't seen that in 15 years, because that's how old Hedgeye is.
Yeah.
Whenever asked, it's like, oh, that doesn't happen here. It's just, but if I take my process, which is kind of paramount in my own, again, thick skull, it's fractal in nature, like as Mandelbrot would teach, that you have these causal factors in emergent properties that are already in motion. You cannot turn them back.
That's right.
You cannot take back the prior that you created, where this stuff is like tinder. Right. And it's the particular point in cycle time that the particular risk happens. So for me, because I have a negative GDP number for Q1 and the Atlanta Fed's at almost +3, we're at -2. And we have the debt ceiling right on the back end of that, like between April and July in terms of this. Like you have a very precise window of clock or market time where all this happens. So for me, like when you say, because part of my case is this, most of my case is the cycle. It's not what you said. It's not that there's actually government or that there's credit risk. I mean, how does that even get priced?
Well, it gets priced because you don't get paid. That's how you price it. If people stop getting paid, then they're going to price it. The assumption in the world is that the U.S. will always be there. We were there after 2008.
Yeah.
We supplied the demand when the markets pulled back. That was the point of QE, but we couldn't stop. That was the problem. You see, Bernanke and company did the right thing with QE. It's very simple economics, right? Suddenly demand disappears, you have to create some new demand. Otherwise the system rolls over. But they didn't have the courage to stop. And they got bullied by the populists in Congress, led by Elizabeth Warren. Congress went off and spent money they never should have spent. We had a party. We had a COVID party. We were banging the pots at 7 every night, having martinis. I was in New York City, but we're in the suburbs now, and I think the changes this has made to our society and is going to make to our society are dramatic.
Really?
And you see the defaults in the commercial space. We are going to watch big guys walking away from legacy office buildings in large American cities because there's no reason to put more money in. And then the consumer, that's going to come also in the same time frame, next 36 months. And what it is you're going to revert back to the mean, where we were in 2019 with consumer, but then that bottom half, the people who were already kicked around by COVID, who had problems, who needed forbearance on their mortgages and everything else. Well, guess who's getting fired now? As corporate America lightens up, guess who's getting fired in the housing sector, where we have to get rid of all the people we hired in 20 and 21 because of the Fed.
Well, that's bad.
This is social engineering on a planetary scale, and yet nobody in Washington and the Congress has the courage to say, maybe the Fed ought to stop doing crazy things.
Well, according to Brian D-Sendat, I call him, kind of a French nickname I gave Brian D-Sendat, the guy who called, he's like the captain of transitory inflation. But he's also, like I always say that, well, what they think about growth and being a soft landing is to growth what transitory from decent that was to inflation. And if you really think about what you just said specifically, the only thing worse if you don't have any money is losing your job, right? And we see all the components of the labor market where people are getting 2-3 jobs just to make ends meet. Most people on CNBC will say the consumer's in good shape. Well, first they said they're in great shape. The savings rates, everything's great. Now it's they're in good shape. And then today we look, Josh Steiner goes through it on the call, which we pay attention to. 60-day auto delinquencies hit an all-time high.
Yeah.
All time, not like sometime, all time.
We are reverting to the mean.
So what happens, and this is going to get to the point that you've been making, because if you haven't read Chris's notes, he's got like, I didn't know how good I knew how good he is, but I didn't know how good your written work was because he put it behind a paywall that I got to read to get prep for this. But But you know, like the return of the double-digit mortgage, you know, that, like as Paul Harvey would say, is that the rest of the story? Is that going to, like, okay, now you don't have a job, or you have 2 or 3, and you have a double-digit mortgage? I mean,
yes. And what's happening, you see, because we had so much overcapacity last year in the mortgage space, people kept making mortgages at lower rates than they should have, and they were losing money. A lot of the big firms were losing a point, 2 points when they sold that mortgage.
Just to get your cash balance. Like
get the cash and keep the servicing.
Yep.
It's a gamble. So in October, before we started this bond market rally, right, you already had the low FICO, high LTV borrowers 10% down, or the special programs. They were already in double-digit rates. And the jumbos, the larger loans that are harder to sell and harder to finance, they were in double-digit rates, depending on the credit, right? The conventional market, no, that was still, you know, 7s, 8s. But it can go back there very quickly, because as we get rid of capacity, the mortgage lenders are going to want to make money. Today, the premium contract in TBAs to be announced for next month for Fannie Mae.
What's TPA?
It means you're selling a mortgage security forward a month. You're going to deliver it next month, third week of the month, right? So a 6.5 is trading 102, 102.5 this morning. That's where you would like to sell your loan, but that implies it's going to be a 7.5 coupon for the loan, because the loan tends to be about a point above the debenture rate on the mortgage security it's sold into. The difference is the servicing, fees, all of the rest of it that goes in, because, you know, when your lender makes you a loan for your house, he's usually down cash. He's usually down a point in cash. He gets some of that back when he sells the loan, and then he keeps your servicing, and he gets paid a little bit of money every month. That's how the mortgage industry works. But a lot of these guys have been getting killed for the past year. So you know over time, if we stabilize rates here, mortgage rates are going to keep going up, because these people would like to have at least a point difference.
So that's why I get pushback all the time. I say, I don't care if the Federal Reserve raised rates by 1 more basis point. You're all focused on 20 versus 50.
Right.
It's, that you're setting, like back to the credit risk at the household level, you're setting their cost of capital at a level that is, you know, vertically higher than it's ever been of the modern era.
You'll have a rate shock, which will become a credit shock. Okay, we have market risk now that is going to become credit risk as obligor's default. Okay. You know, the average credit card rate today is over 20%.
Yeah, I show that chart in our macro deck. People are going, well, that's not my rate. Like,
Yes, it is.
The hubris of Wall
Yes, it
Street,
is.
right? I mean, it's the rate.
And it impacts non-bank finance, because they work off of spreads. And when the short-term rate is 6.5%, okay, that kills you.
So how does, like, okay, so we're going to have a full-blown, you're more bearish, like actually if I take your framework, I'd be more bearish than even I've been bearish, which is like revenant type bearish.
Well, the key factor to add to the analysis, Keith, is volatility. What the Fed has given us, much like climate change, right, is volatility in terms of markets and the economy.
Rates.
That is, frankly, is frightening.
Yep.
I mean, the rate of increase in funding costs that we're seeing, and the rate of change in the composition of liabilities of banks that we haven't seen before. Look at U.S. Bank. U.S. Bank historically had 40% of their deposit base in non-interest-bearing corporate deposits. You know, payroll, all the stuff they do. They're a big payments platform, but it's changing. People are putting their money in interest-bearing accounts now.
Yep.
So this whole
Good
change,
deal.
as it ripples through the system, banks are galloping along. They're trying to replace assets. Remember, most of the big guys turn over 20% of their book every year. They have a weighted average life of 5-6 years. They manage the risk short. They want to keep time short. That means you've got to go out and find new loans every month.
Is that what's, I mean, so I have, like, when I look at like my big cash positions in my long only, like my kids' accounts and stuff like that, at like Fidel, so people see, I show one of the accounts just so people can see what my weightings are of asset allocations essentially. My biggest is the Fidelity Cash Plus thing, or whatever the hell they call it.
Right.
And you have to have X amount of money in it, but it's like a 4.5 or almost a 4.7% yield.
Right.
And I keep seeing them making these transactions inside of my account, inside of that thing. I don't know what that is. Is they have to constantly, like, yeah, I don't know. They have to constantly have transactions to maintain certain Like,
I don't know. I'd have to go through.
I'd have to.
I think you should consult your financial
Yeah,
advisor.
I'm just kind of looking at it. Well, first of all, the good news is if you're not an idiot,
Right.
and you didn't lose 20 to 80% of your net worth last year, and you're still trying to get back or right around the all-time high of your pile. I mean, I put currently I have like 75% of my pile in that.
Right.
Because every month, that's what I get.
That's right.
Which is the first time that I can remember that, well, because I never had a pile before, that I ever got that.
Well, look, in 20, I deliberately got out of all of the common in my portfolio. I always publish my portfolio with my reports.
Oh, you do? Okay, cool.
Oh, yeah. It's a very simple portfolio. It's bank preferreds that I buy cheap. I have a contest with some of my big buddies in the mortgage industry to see
A contest.
who can buy the most Citigroup, the grandfathered preferreds, the 9 3/4. We collect those. But there's a lot of other value there, and that's my dumb and boring part of the barbell.
Yeah, that works.
And then I got the NVIDIA and the Chevron and all the other stuff, but it's 60-40. You know, I'm getting up there, so I got to make estate planning, right? And it's worked very well. The vol on my portfolio is negligible.
Yeah, because that big piece doesn't move.
Oh, no, no. And, you know, opportunistically, if we get another frantic sell-off in this market, I would tell people, go shopping for income from the banks. It's not like the banks are going to disappear. But remember, in a rising rate environment, it's bad for book value. And when you have the Fed adding this volatility, I think you're going to see a lot of banks have to take some pain, sell the old stuff, the 2s and the 3% coupon, and buy higher coupons. Because, you know, do the math, take the pain. And this is why I've been pounding on the Fed and on Sandra Thompson at the FHFA. She's the regulator for Fannie and Freddie. Sandra and her GSEs can issue CMOs. They can issue CMOs for the Fed and restructure those cash flows so we can put more of that duration back in the private hands, get the Fed's balance sheet down on the one hand, and for banks who have the capital after they take the hit to clean house, let them keep the long zero piece, okay? The deep discount piece of that CMO, because that could be a home run.
So what CMO is what again?
A collateralized mortgage obligation. We haven't made them in a long time. But it was, listen, it was the CMO. My dear friend Fred Feldkamp taught me the CMO is a way of dealing with the variable duration risk that you have in mortgages.
Yeah, I mean, you just take it,
you slice it up. You're slicing it vertically instead of horizontally, okay?
Yeah.
And there's one investor that wants that AAA rated front piece that's going to pay off in 3 years, and there's an insurance company or a hedge fund out there that'll love that tasty zero coupon discount piece for when the Fed drops rates. That's an institutional trade, mind you.
Yeah, but the high net worth trade should be, like, why would you buy, like, why would you, if you know anything about macro or current, like, rates volatility, which is ripping,
right.
Why would I buy 2s, 5s, 10s, 20, 30s when I can just have Fidelity pay me 4.5% to 5% for sure with no vol? I mean, everyone should be doing that. And the more people do that, the more screwed the Treasury market is, obviously, because you take away part of that bid. But anyway.
But this is healthy. We have to redistribute investors in exactly the way you're talking about to get out of this crowded equity-only, long-only trade that we've been in because of the Fed. The Fed has done such damage to markets, to individual investors and institutions by messing around with stuff that frankly is none of their business.
Everything, like you'll hear, I heard it well, this is another story. I went to Mar-a-Lago for dinner, man.
No.
Yep.
Okay.
I did.
Well, you got back.
I'm a big Trump guy, you know. No, but anyway, I was seeing clients. We had our Miami conference, and then on the way, like I went from Miami to Palm Beach. So I'm playing golf with this family office high net worth group of clients, and they just reminded me, like, you know, when you have a couple beers and you're just kind of like thinking and talking and just, you know, venting in this case, it's like they kept telling me, do you know what the typical asset allocation is for some of these major Palm Beach families that are in our family? And it's like 20, 30, 40% in alts, right? What are alts? Well, we know what alts are. I mean, it could be private equity, it could be venture, it could be angel, could be fruit cups that are going to go to the moon in coin terms. But that's on the Fed too. Because it allowed you, like everyone, okay, well, here's the juice. Like this stuff really doesn't move. It's kind of like BREIT. You know, like Steve Schwarzman says, hey, look, I don't know what you're talking about. It beat the S&P last year.
Well,
but it doesn't. But you can't get out.
Yeah, no,
it doesn't tell me anything about the drawdown.
No.
Right? What if you told most people that worked their ass off to make something like of consequence, and you said, I can guarantee you this year that you're going to be up 5%. You just put it all here with no vol. Or you can, kind of pretend that you understand what's in your liquid alts portfolio. That could be down 30 to 60%.
Well, you see this now in fintech. All of these companies are borrowing to pay for earlier obligations. They're going to the market. I mean, the one Stripe is actually going to raise money so they can cash out their employees and their stocks.
Yeah, so it's like I was told this as well. So they're just basically replacing one person, like one cattle class, getting rid of one liquidity problem.
But I don't understand how we make awards like this. I mean, look at a firm. A firm has lost money every year because of their comp to their insiders.
Because a lot of people that run, and I've got a finer appreciation for this, a lot of this RAA, thundering turd Merrill kind of thing going on, whatever, they're brokers, right? Like they don't know what the fuck's going on.
But they have,
so they're like, we're going to put you in that because that's got a good return.
But these people have been driven into this corner of this crowded trade.
Right.
They've been driven into liquid investments and quote unquote private equity. I wouldn't even dignify it by calling it private equity. And so, they're going to get crushed. This is misallocation of resources. When you have people playing God in Washington behind you, remember the Wizard of Oz with the buttons and the levers? That's Jay Powell. And he's trying his best. I don't think he's an evil or disingenuous man. But their mandate has got to be changed, or we're going to destroy the country.
I mean, okay, so there's that. And then when you said CMO, I thought I heard CLO. So CLOs.
You can have whatever letter you want. We got to slice the cash flows.
So CLOs, same thing. So a bunch of Japanese pension fund investors or Europeans or U.S. investors, they're like, I like that yield. I don't really care what's inside of that.
We can do those too. Let me give you an example. The Federal Home Loan Banks. Take a guess at how much low coupon paper they're sitting on.
No idea.
Hundreds of billions of dollars.
Oh, what?
This is not stuff that you keep unless you have a low cost of funds.
Yep.
What is the funding cost for the home loan banks this week? It's over 5%. Okay? Might as well be an S&L. So again, I encourage Powell, Sandra Thompson, Janet Yellen, they all need to have lunch. And they need to talk about how are we going to do a little maturity transformation here before we get to the fourth quarter and investors are forced by GAAP to start making a decision about pulling assets out of a portfolio that they had already designated as held to maturity. You know what happens when you do that, Keith? You've got to revalue the whole damn portfolio to market.
Well, that CLO is like
it's a disaster.
In Miami, it was a great, when you have like a round table dinner with different kinds of clients. And one in particular was like the CLO manager to an extent, or said we had huge allocations. He's like, that game is done. He's like, you're not coming back at those rates ever again.
Imagine if you bought a structured product 2 years ago.
I mean,
oh God.
But that's a massive market.
Because they were driven into it. People were so desperate for yield.
Right.
If I'm the Fed and I take $10 trillion in notional duration out of the market, I then raise target rates, and now I've got 20-something trillion dollars in effective duration adjusted, weight if you think of it, inside my central bank, totally isolated. We don't sell against it, so there's no pressure, downward pressure on rates on the long end. That's why the curve looks the way it does. Out to 50 for swaps, it's what, 30, 40 bips below Treasury yields?
Yeah.
This is not normal. So anyway, all I can say to you is the Fed has made a huge mess, and it would be nice if we had people who could come together and talk about this, but we don't. Washington is totally dysfunctional.
So you think it ends the way that I think it ends? There's this, there's an event, and then you have a new administration that comes in and cleans up the mess.
Well, I hope, but if Joe Biden thinks he's going to have an easy glide into re-election, I think he's badly mistaken. He's picked the wrong person to tell his story on the economy. She was one of the bad actors at the Fed. She's been there quite a while, too. How do you absolve her of the association of that? And I think also, you're right, we're going to see some idiosyncratic failures in commercial real estate. We may see a couple of banks go down because of mark-to-market. They're getting ready to give
nobody's thinking that, dude. Oh, the banks
banks are so well capitalized.
So cheap.
Remember?
Cheap.
No, they're not well capitalized when the Fed moves rates 500 basis points. Okay? You know, read that piece about Silicon Valley Bank that we mentioned in the blog. Stunning. That bank is essentially on a mark-to-market basis insolvent. So I have a problem with that. The Fed needs to be cognizant of how their actions impact the real world.
Today, I mean,
and consumers too, by the way.
Yeah, I mean, full disclosure, I've been short this Silvergate, which is like pretend bank, or whatever.
One of our favorites. We've been writing about that for 2 years. I remember when it was 12 times buck, and years ago when I worked at the Fed in New York.
That really?
12 times buck.
Oh, but it's a crypto bank.
I know. But anyway, I was taught years ago, if you pay more than 1.25 times book value for a bank, you will not get your money back. What does this mean? It means that if you're doing something that drives your equity up to values above that, then there's more risk. And you better find out what that is. Now, you know, American Express, 5 to 6 times book, they're very efficient. They turn assets. So that's why they're up there. They're more finance company than bank. Capital One, deep discount, you know, Citi, deep discount. But then you see these crypto things, and you knew they were coming down. I have friends who started shorting that back in 20. Good friends of yours, too, by the way.
And there's SBNY, that's the other one.
Well, a very sad tale. Signature Bank draws its legacy from Republic National Bank and Edmund Safra. Yeah, that's where they came from.
Ooh.
When they finally got loose of the non-compete with HSBC, after the acquisition, they went off, started a bank, and then my wife and a bunch of her colleagues started a big family office. That's and they've always banked the offshore community, very cautious. So when I saw this, I couldn't believe it. I mean, this is such a valuable franchise, Signature Bank. To risk that by getting involved with something like crypto? No, it's unconscionable.
Well, I mean, it found its way, even though people won't admit it. I mean, the amount of people that had pie charts 2 years ago that crypto should be 20 to 40% of your asset allocation. I mean, it's just the things that people do at bubble peaks. I mean, it's cyclical
And
peaks.
again, I would blame this on the Fed. I wouldn't take these people to task over much, but I would spank them, because any financial professional who couldn't look at crypto and see fraud, I don't know. I mean, I sit on a FINRA committee, and I've raised this many times. We should not dignify crypto by regulating it. You leave this to the State Gaming Commission. Thank you very much.
Yeah.
That's who should deal with this, and the money transfer people at the state level, who are very good, by the way. They will deal with this. But don't dignify this by regulating it. This is crap. This is money laundering. This, you know, and the thing is, if you could just have Americans doing crypto, would it be as exciting? No. It's the offshore dimension that gets crypto moving, and I think it's also the biggest risk. Everybody who touched crypto the last few years, they're going to get a call from FinCEN. They're going to get a call from the other regulators, and it'll be late. You know, the wheels turn slowly, but they do turn. And I think every depository that got involved in crypto is going to regret it.
What do you think about the broker-dealers?
They've been more careful. Most of them, like Robinhood or you know, Interactive Brokers, they pass you through to a third party. So technically, it's a FINRA matter. It's not a security. They're just facilitating it. But I wouldn't want to be affiliated with a broker-dealer that was involved in crypto. No, definitely not.
Yeah, I had a real conversation with David Dorr prior to this one. I don't know if you know who he is, but
yeah, of course.
He he's just like almost with 100% conviction. They're just going to shut it down.
Yes.
Like, you know, from a regulatory perspective, and I'm like, what does that mean? You just you wake up one day and your accounts are like decayed at all these, you know.
Well, they've made clear that they don't want banks being custodians for this stuff. They've told banks they may not get involved in the activity without getting permission. This was FDIC and the others late last year. So they have pretty much, and I can't imagine what the informal guidance is like from the examiners, but I'm sure they're telling them to stay out. Just the AML and the KYC part is problematic, Keith. You know, you've worked in this industry long enough. You can't do this. You can't facilitate people on your platform unless you know who they are.
Yeah.
Totally. 100%. And if you can't document that, you're in big trouble.
Yeah. It is so basic how
I know.
The basic fraud.
Well, yeah, but these are children. They come into Wonderland. Look at the guys at Robinhood. Oh, gee, we have to do that? They didn't even know. Remember?
Oh, my.
Remember Lending Club? Oh, gee, we have to file a prospectus to sell fractional interest in loans? Yes. So what can I say? It's a discovery process, and the lawyers will benefit.
Oh yeah,
Oh,
big
yeah.
time. I mean, the regulation happens after everyone loses all the money all the time. That's what happens. You have any thoughts on what's going on in the options market from that perspective? The thing about conspiracy theories is that a lot of them can be right. I mean, so when somebody says to me, like, how can this manipulation in the options market or order flow, it's explicit, how can that go on and on and on? And in my head, like, it's not even a conspiracy. I'm like, they're too busy trying to figure out how they're going to regulate crypto. That's beyond their pay scale.
Yeah, it is.
So I just got a call from the Fed about it, so evidently it's got somebody's attention, but it's not like an SEC thing yet.
No, but look at the proposals that Gary Gensler has just put out. There's 4 major SEC proposals, and one of them gets rid of payment for order flow by effect.
Really?
Yes.
When was this?
It's out there. I'm telling you.
It's out there.
Gary put this out. I mean, it's a major change to best execution. It's a major change to registration requirements.
Ooh.
Many managers of funds and other entities which so far have escaped registration are going to be forced into that non-dealer ghetto of FINRA membership.
Ghetto. I mean, how is this not regulated? Like, if
it's about to be. I don't
yeah.
think the rule will get through, but it's an extensive piece of work they dumped on us. And it's astounding that they would put all 4 rules out there at once. You would normally do kind of the easy ones first and then move on. Like changing execution, changing the best execution rule after all of these years, that's what he's trying to do. He's basically trying to create one virtual auction. And he's saying it's not even a matter of making sure that you're not going in front of the customer or anything like that. You're basically going to have to create a new flow in your dealer that exposes the order to the outside world as they define it, right? Then at that point, you decide whether you can execute it internally.
That's interesting.
Oh, it's a big change.
Huge change. I mean, because right now, when I started in the business, the order would have footprint. I mean, not even when I started in the business. I mean, I haven't ran money institutionally in 15 years, but it's like you call Susquehanna or you call Goldman, you're like, I want to buy 10,000 SPY puts or whatever. And it's like it's an order, everybody can see it. Susquehanna, they have their own, it's their own skin in the game, so you can't rip them off. These things had footprints you could see when somebody's making a bet. Now, it's like, you could be at Susquehanna and you could say, wow, a shitload of options traded today, and we didn't see that.
But this is the thing, the SEC, especially the Democrats on the SEC, believe that with opacity there must be bad acting. And so they believe that if we're executing this stuff away from the exchanges, they must have inferior execution. They may be wrong, they may be right, who knows? But we don't know. So they have come up with this construct that says, well, this is bad, we have to change this. And that's what's behind this rule. I spent hours talking about this at the last committee member meeting I was at FINRA, and it's very significant. This isn't FINRA, by the way. This is the SEC.
Yeah.
The SEC is even going to issue kind of, sort of something that looks like the way FINRA deals with issues via arbitration to give them rulemaking authority, because they've never actually issued a rule at the SEC level for those sorts of things. Oh. So we're actually going to have 2 standards. It's mind-blowing. It really is. It's not like the street needs this right now. We have other things to worry about.
Well, I mean, and that's the whole point, is that order flow has become, you have to think about a lot of things when you think about the market, but I mean, if you're Mr. Fundamental and you're not quantamental, that's one thing.
Right.
But if you're not quantamental and you don't see order flow driving, again, the suppression of immediate term volatility and its impact on the indices.
But if you're any of the big execution shops, you need to be focused on this right now. You need to be talking to your lobbyists right now.
Yeah. I mean, Susquehanna paying attention. I mean, they built a great business. I mean, those guys in options, they're fantastic.
Imagine if we had to restore commissions for retail trades.
Oh, shit, man. That would kill me.
No, but I'm telling you, it's not explicit in the rule, but if you go through the way they have crafted the exceptions, there are no exceptions. You would never do it that way. So they're going to force everybody into this new model. and it's going to be a problem. It really is. Because there won't be the economics there that says, oh, well, Joe can do trades for free.
Well, I mean, like, I like to, tell me if you agree or disagree with this, because this is, I almost say this at this point, every institutional client call that I have. Because I'll get a question, 100 more than one in some cases, questions about this, the flow of the machine relative to the sophistication on one side, and I say the manipulation of the emotions of the other side. So it's like, they're highly sophisticated players, highly sophisticated, know exactly what they're doing in the options market. On 0 days to expiration, you better. Or weeklies. And a lot of this is structure, right? You never had weeklies or dailies before. And now they're talking about, like, I think maybe hourlies. But you have a highly sophisticated and motivated and profit-generating institutional activity. And you have explicit manipulation of a bunch of bozos who never, you think that Tesla's like a second coming of Jesus Christ. To a Catholic, that'd be pretty serious. But you could see it in the weeklies. I mean, today, again, the Tesla weekly calls, they're trying to get it's because they know if they get that thing to print, you got a lot of people that are going to chase that thing.
But would the GameStop phenomenon have occurred if it wasn't for QE? I don't think so.
No.
Right? So we empowered that crowd of crazies on Reddit. I've never understood Reddit. I tried, but I just gave up. They kept giving me coins. I didn't know what I was supposed to do with them. So yeah, I worry about this because all these phenomena that we've observed over the last 3 years, Keith, tell you that the market is, recovering. It's going through a bad period. It's been through heavy manipulation. And I think a lot of investors are rightly confused. If you weren't confused during this period, there's something wrong with you.
Well, very few people have been indicted for market manipulation.
Yeah, we should start at the Federal Reserve Board. See, years ago, when I worked at the Fed in New York, we manipulated markets very gently, but we were always careful to make sure that nobody noticed.
Are you serious?
Canadian dollar futures.
Oh.
We would come to the rescue of the Bank of Canada. Canadians would be on the phone screaming, and we would call the guys at Rudolph Wolf, and we'd say, go to the pit and buy everything you can find, and call me back in 20 minutes. And we'd watch, and the spot rate would go up because spot was very thin. The futures were the big angle in that market in those days. No fuss, no muss. We'd throw them a spot trade in a couple of weeks to make up for the loss. That was it. No documentation, nothing. So the Fed occasionally, I'm sure, has interviewed all sorts of futures, S&Ps, the whole bit. Today, I'm not so sure. The Fed has become such a pedantic and bureaucratic organization. I don't know that they could carry off a market manipulation right now.
That's a very good point because
they are honest as the day is long. Don't get me wrong, but they operate it like the post office. So you are not going to respond quickly. Let me give you an example. I once asked I once asked the governor. I said, "Why didn't you call the guys at Wells Fargo and tell them that there was a problem and that you needed to see some changes? The false account problem." Well, years went by. The Fed didn't do anything. They didn't call anybody. Oh, and I said to this governor, I said, "Why didn't you just rattle their cage and tell them that they needed to clean up the mess?" "Oh, we don't do that now." Well, we used to do that when I worked at the Fed in New York, and you know what? Stuff happened. We didn't have problems. We got ahead of them. We merged dead institutions if we had to. Manny-Hanny, my favorite. Chemical Bank, another one. And yet Chemical became Jamie Dimon's ace in the hole. They were the guys who processed all his acquisitions. Very important technology platform for him.
I've never heard anyone. I've heard a lot of things about the Federal Reserve. I've never heard anybody say they run it like the post office.
But now they do. Not in the old days, it wasn't like that.
I'm actually. Have you read the book, The Whiskey Bank Robber?
No.
Sounds
like I should.
Yeah, you got to read it. It's about this Canadian. Well, it's not Canadian. It's a hockey player in Hungary who became like the most post. Communist fall in Hungary, he became the most infamous bank robber, and he was just actually robbing a bunch of post offices because that's where Hungarians would stash their cash or have their cash. I just kind of like thinking about like how easy it is to see what's going on, like he did. He's like, this is so easy, so easy.
Think about it. A century ago, in a country that barely had money, okay, and the money was of uncertain value. Postage was actually quite valuable.
Oh, very valuable.
Charles Ponzi.
Yeah, and this guy, there was, and then obviously technology disintermediated cameras, alarms. Anyway, if you don't mind, I'm gonna get the questions from the crowd. You're gonna get a lot of questions as usual. If you have questions for Chris, they'll get voted up, and if I like them, I'll ask them anyway. Of course, this is the top-ranked question. Chris, can you explain and expand about what you said about U.S. default possibility? Thank you, from Paul.
Well, if the cost of the debt starts going up, if it's no longer zero, it will become a big drag on the federal government. And remember, we're already talking about Social Security. We've got to figure that out, probably higher taxes. Biden has talked about taking the cap off of Social Security. And so over time, the dead weight of the debt, remember, and this is a market problem, it's not just the Treasury. Most of the debt out there is just being rolled.
Yep.
It's not doing anything to contribute to growth. It's a dead weight. And so eventually, when the debt gets big enough, countries tend to default on it. That's just the history. We are no different than the Greeks and the Romans.
No, but I mean, just to give people context on your history on this topic, I mean, some people have said this for the last quarter century that I think I've been on Wall Street, and it's like some of them, it's just like tinfoil hat type shit. But you just started saying this?
No, I've always been concerned. But when we drove rates down to nothing, they were buying time.
Right.
Right.
Okay.
When they're buying debt on the balance sheet of the Federal Reserve, you are starting to default. Okay, because you're giving the Treasury that money back, right? It's inflationary, clearly. You're paying for it with inflation. And by the way, we're going to go buy $3 trillion worth of mortgage backs, and we're going to confiscate that income for the Treasury, too, for economic growth. That's bullshit. The major beneficiary of quantitative easing was the U.S. Treasury. And if you can't figure out that, and if you can't take the lesson from that as a private investor, as an owner of private assets in the dollar sphere, then you're missing the point.
Yeah. So you don't think that, well, I mean, you don't think that there are a bunch of things you could do it all over again. Could you do do you think there's a possibility of doing QE and doubling the size of Fed balance sheet? MMT is still kind of a discussion as opposed to a practical.
That's what QE is.
Yeah.
QE is MMT.
Yeah.
The MMT guys were just not fast enough to take ownership. It's like ESG. Remember, we had governance, and then we added E and S to it.
Yeah.
It was very cute, actually.
Good.
They kidnapped the whole corporate governance world to focus on green. But
wouldn't QE be the answer to default risk?
It is, but here's the kick. The reason the U.S. gets away with this, the reason that the U.S. has a negative spread on swaps, right, is because people want to hold dollars.
Yep.
If you convince them not to, if you continue to act like a bunch of drunken Argentines, which is what our Congress has been doing, then eventually you will convince them to go elsewhere. It's just a matter of time. Do we want to really find out? I think eventually people like a DeSantis, your former colleague from Yale, are going to raise these questions. And I think the same voice of conservatives, which I agree with, by the way, that says, do we really want to get involved in a European war?
Oh, my God.
They're going to ask questions about spending, and it's very topical, because Americans, believe it or not, Americans are actually figuring out what inflation is again.
Well, this is it's not one of the questions, but it's something I didn't ask, and I should have. Back to the DeSantis point. Like, very few people have actually listened to Powell and actually believed them. We know what Wall Street wants. They want the pivot. They want the dovishness. They want QE. But what he said is very consistent. And he's was a pissed off Republican. I don't know how he is now, given what Janet and Brainerd and that whole crew tried to do to him. Brainerd's given up. She's like, okay, I'm going to go back to the White House. I'm not going to be the head of the Fed.
Yeah, fair enough.
And he'd be sitting. So he's now like in the catbird seat, looking at a potential DeSantis. Like, would that be, like, from his perspective, DeSantis's perspective, looking back, and maybe Powell, we got a nod, or we'll do that. That would be an extremely powerful political pitch, which is, we're done with the easy money, we're done with the drunken sailor spending. We want a strong dollar. We want rising purchasing power through the lens of a strong dollar. It's very like Reagan-esque coming out of the Volcker tightening. Do you think that that's possible? Do you think that he gets that?
Well, we have to refute the progressive economic model, which has governed the Fed since the creation of the Board of Governors. Remember, the Fed is a New Deal institution, not the reserve banks,
right,
but the Board of Governors in Washington. And I think you have to make people understand that we could actually have very low rates and very high rates of growth in this country if we got federal spending under control. Because what you're seeing now, I hate to tell you, is crowding out. Sure, we can expand the money supply to accommodate it, but we're going to impoverish all of our people. They won't be able to afford a home. They won't be able to afford food. You won't have, you have people living in their cars working for Amazon. That's crazy. And it tells you why the politics in this country have turned, because people are hurting. They need help. Washington is the problem, and we need a politician like a DeSantis, or maybe even former Governor Haley, to go out and tell that story. That's what we're needing, because no one has had the chops to go head to head with the progressives. They scream and yell. They're kind of scary, but no.
And the Federal Reserve is Republicans and Democrats have been the same on money printing. They've been the same. I mean, it's not
like. Well, think of it from Greenspan on. Have we had any leadership from the Fed? Did Greenspan ever growl on Capitol Hill about deficits? Occasionally, but not too much. Yellen? Nah. Yellen is like the little bobber you put in the water when you're fishing. She goes with the current, right? And then Powell, I like Powell intellectually. He tells us things occasionally that, of course, the media don't understand. But he's not a leader. He's not been willing to take a leadership position and therefore take risk. Biggest problem in Washington today, Keith, is that people are afraid to take risk and maybe have to resign for standing for something.
I mean, if and I know you had, let's both do this. I, as the leader, I'm going to tell you what I do. You tell me what you do. If I was DeSantis, I would say exactly what I just said. I'd say the game is over. We're going to have a recession, just like 1981. We're going to get rid of all this bullshit. We're going to have a strong dollar is going to be the focus. The savings rate that matters for Americans. It doesn't have any credit risk, doesn't have any volatility, and we're going to level the playing field.
Can you imagine if you were issuing less net debt, how strong the dollar would be?
I mean, this is not that complicated of a political message.
I know, but that's my point. Don't spend the corn. Don't eat the corn.
Now, most of my institutional clients that would lose on that trade don't like that. But is it
because they like inflation? We're human.
But still, when you're trying to get elected, you're talking to the people. You're not talking to a select group of asset managers.
Which people? If you're talking to middle America, they like that low inflation, strong dollar. If you're talking to the party animals on either coast, nah.
Yeah. So what would you say? Like, what would your leadership message be?
I would say that we can have a liberal society that protects all Americans and still be fiscally responsible and not bankrupt our country. We can do both. We have more than enough resources to do what we need to do. That's the message. And I think Americans want that. They want politicians who are going to really be fair to everyone. They don't want somebody to get up and start, yelling and screaming about how gays are evil or something like that. They want someone who embraces the secular role of the presidency and does a good job managing things. And at the same time, make sure that we're counting our pennies. Because we want to have the capacity to expand. The strength of the United States is the fact that we have a private bond market. That's why the economy recovers, because we go out and finance stuff. We create opportunities. That's the strength. So you don't want to mess that up. And you don't want to have the federal government as the biggest borrower in the market every month. If you look at today, look at who's issuing. The agencies and the Treasury. Everybody else is going to zero because of the current rate environment. If I'm at the Fed, that's the chart I would pass around in the room. I think also they have to be cognizant of duration. I think the Fed should watch total market duration and measure that as part of their overall policy.
And they should consider you. Like if it was DeSantis and Powell and they were trying to reconstitute, you'd be great. I mean, it would be a rough ride for Wall Street as they currently price risk. To get through
stocks would come back into vogue.
No,
listen, this country would grow so rapidly if we got the government out of the way. I'm astounded at how well we have done with COVID, and that's because of the private sector.
Well, we also had to create massive bubbles to do well.
Yeah, but the government got in the way. If we hadn't have done that last fiscal spend, we would be in much better shape, and Powell would be in a much different situation in terms of managing this. I don't know how you take trillions of dollars out of the system. In a lot of ways, you can't go back with QE. Bernanke said this early on when they were talking about this at the board, and he's right. How do you take the liquidity out? How do you know with your Fed model, your equilibrium model, which is how they do this, by the way, how much liquidity we need in the money market?
Oh, they don't do it.
Think of the idiosyncratic aspects of that calculation, the offshore piece that we never talk about. How do you calculate that? You can't.
No, you just you make people believe, just like a storytelling stock or like Elon. The best thing to do is tell somebody a story that they believe, because they wouldn't know otherwise. It's just easy to believe anything.
We're humans.
You can believe anything. Here's a good question from Holly. Chris, I've read various writings of yours over the years, re Black Monday, 1087, obviously. Does the current environment bear any similarities with the months, weeks leading up into that event?
Yes, because of the crowded nature of the equity markets right now.
Yeah.
All managed strategies, all in this corner, desperately looking for something to buy. Look at the banks.
And the hot start to January of 1987.
Oh my God! If we had more conviction in that rate cut by mid-year, oh my God, the markets would have soared. As it is now, I follow the financials very closely. They have moved. JP has been sitting at 1.5 times book value for months. The managers want to buy it. But my point is that you have managers parked in these assets. They don't know where else to go. Can we have a break? Yes. I think the big risk that we haven't tested, because we've been in a low rate environment, is obviously the ETFs and some of the other funds, because if the sponsors don't stand up, then the price is going to fall. So again, volatility. We have the potential in this market to gap enormous percentages down. Why? Because the banks don't trade their portfolios. They're not allowed to under the Volcker rule. They used to make markets around their bucks. They can't do that now. So we put in place all of the criteria that you would want to have for an 87 type meltdown.
Yeah. Fully loaded with the performance chasing to start 1987.
Correct.
The two worst things that you could read that while CNBC thought it was bullish, they're like, oh, it's the best January for the NASDAQ since 2001. Or the best January for the S&P since 1987. People just, and that's my biggest concern, the people always, because it's one thing to believe something. Every one of us in markets at some point believed something, and we paid the economic price. It's another thing for a whole generation of people who would know, that really, post-pandemic made money, and now are sitting there thinking that they can keep doing this. I mean, it's like, yeah, it's on them for being lemmings. I get it, but I mean, to perpetuate that. It's sad. It's actually sad to watch.
I think it's cool that you can now just invest in a treasury portfolio and make more than that 40-60 portfolio.
Okay, one more question. This is because I hear this too. This is funny. Because European indices had gone back up, and they're led by the banks. Banks are up 20%. If you look at the bank component of the Euro stocks, it's up 20 to start the year. Now you talk about a chase, and I hear quite often, oh, they're as healthy as they've ever been. So this question's very good from Robert Magrorty. It's been 10 years since we've seen like GBT, Great Britain 10s or DETs like German 10s at these levels. Could you discuss the potential impact of rising rates on Europe and European banks?
Well, the European banks' biggest problem is that they just don't have profitability.
Right. Which is why people say, hey, that's good. There's some NIM there now, finally.
Well, yes and no. I mean, NIM it's about spreads. It's not about rates in the market. It's about where their assets are versus their cost of funds. So, for example, I have been opportunistically buying Credit Suisse. Why? Because they're getting out of the investment banking business. This is a huge factor in the U.S. mortgage market, by the way. Because they were a key facilitator of the government market for the last 10 years.
And CLF.
And they're leaving the room, which is not good. I would tell you, I did that because I know that the guys at the Swiss government and Abu Dhabi and everybody else are going to fix this and turn it into UBS. UBS trades at 1.5 times book. So that's Chris's thesis there. The rest of them, I would be very careful because government takes a lot of the bread and butter financing in Europe. Then you have little niche privés and whatnot in Switzerland who do asset management. I think that's the only area of European banking I would look at. The lending piece, no, you're competing with governments.
Yeah.
And there is no middle market. This is why Deutsche was always having such trouble. They tried to be a global bank, but they didn't have the deposit base at home, and they didn't have that core middle market business to feed them. You know, you need that. This is what Citi is facing. They have consumer, they have kind of a okay capital markets business, but they don't have an asset manager. I keep thinking maybe we slam them together with Goldman. What do you think?
Actually, maybe last question on that. That thing was pretty violent to the downside the other day. What do you think's going on at Goldman?
I think they're going to have to make some changes. I have been saying for a long time that they should have combined voluntarily with a decent-sized regional. I love Key, $100 billion in Main Street core deposits, and they like commercial real estate. They are a servicer and a back office provider for that market. I thought, you know, because that's a
Was that ever a consideration? I mean,
no, they didn't want to do an acquisition. They didn't want to lose control because the guys at Goldman today are regulated like a broker-dealer, not so much like a bank. If you combine them with a big bank, then you know that the Fed is going to want the bankers to run the combined company. They would probably tolerate the big broker-dealer and let them do deals, but it would be a different culture. It would be dramatically
very
different. But I don't think he has much choice. I think that David got the cards he was dealt. They don't let you ask for more cards in the Wall Street game. You just get the 5. And no, really, I'm not critical of the guy because he's a smart guy. I just think that they have a business model which is not really sustainable in a world of big universal banks. Jamie Dimon. Jamie's half securities, okay? He's running a mutual fund, hedge fund, whatever you want to call it, and then the other half is the bank. If he could spin off Chase and the credit cards tomorrow, would he do it? Yeah. Because the risk-adjusted returns are just not there. This is why Wells is pulling back. They've been spanked enough, they've shed enough blood in fines, and they just don't want to do it anymore. So all of these institutions are working in a highly regulated world. Look at Europe. Oh my God. You know, you don't start new banks in Western Europe. You're not allowed to. And I think that all of them are going to have a big asset management component because it provides stability. You know, look at Schwab. Charles Schwab is the 7th largest bank holding company in the United States.
Wow.
$600 billion, right? It's all core deposits from advisors and their clients. They make mortgage loans to the clients and keep them. So pretty cool business. If anything, they should turn up the risk a little bit on the bank. They could make more money, but they don't care. And you know what? That's okay. Big, dumb, boring business. It's wonderful.
Man, the historical context that you provide and just like putting it all together at the same time.
Well, it's the coral reef, really, guys. Remember, banks are not the same. When they treat them the same on the big television programs and they try and just talk to you about earnings, no. These are very different animals. Like, remember our friend Bill Cohan wanted Bank of New York and Goldman merge. I'm like, no. Can you imagine that culture clash? I don't think anybody would survive the first meeting.
Yeah, he's done a great job writing too, just like
I love Bill.
Now that I'm behind your paywall for a little bit, I'm going to keep reading your stuff and I'll keep, it's a very good thing to have you doing that because people can now just learn at a faster rate. And the problem, of course,
we have fun
with like the rest of the media is that it's like, it's like looking, it's I don't know. It's
well, we get a lot of questions like you do, and I try and either answer them on Twitter or on just in the writing.
Twitter's a great. I mean, like you get to pick your own questions. You block the crazies. You pick your own questions. That's how we educate. It's great.
I like what Elon is doing with Twitter. It needed a little shake-up.
Well, you're doing a good job on Twitter. Thank you for being a good, called good corroborators out there.
We have our little community over here. I'm not sure about the rest of Twitter.
Well, thank you for also being on Hedgeye TV again and
my pleasure,
for being here in person. Appreciate it. He's Chris Whalen. I'm Keith McCullough. I hope you enjoyed our real conversation.